What's up, guys? So it's gonna be our first episode on the Icon Investment channel. Something new, interesting. This is what I do with my money and how I invest into different companies, stock market based. Also, I want to get into like the shoe reselling because that's something else I do from time to time. Usually, don't do it that often, but it's fun to do. And yeah, okay. So I'm gonna show you what I like doing in the stock market in general, and I'm gonna show you DraftKings because I opened a position in DraftKings on Monday, which was thinking of opening a position anyway on Monday. But what I do is I trade options, which is what this means. If you buy a call, like the price is like at this amount, if you buy a call, you want to buy it above this price. You want to buy it like, let's say you buy one here, right? You buy a call, and then what you want to do is since it's at let's go deeper in. Since you're buying at 0.95, that's basically times 100, right? So if you were to buy one, you're paying $95 for that contract. Well, not really a contract, just an option call. The calls are pretty much in a way betting that the company is gonna go up. Like the price is gonna go above this, is gonna go up. And that means if it goes above, you could sell it for more money and make a lot of money, depending if it goes up. If it goes down, you lose money. Like right now, I went up to 98. You're making like $2. But yeah, that's how that works. You could also sell a put, which is the opposite. It's saying that you want the company to go down in value, which again is not bad. It's also something that you could risk a lot if you buy it like at 8. It goes down to 70, you're losing. It goes up to 90, you're making money. But this is betting the company goes down. But what I do instead of doing that, because I don't like the risk of just buying contracts weekly or like every 2 weeks, I sell puts. Which selling puts is completely different in the sense where it's like you sell a put at minus 80, right? So the difference is that they're paying you $80 instead of you paying them 80 and waiting for it to go up. They'll pay you $80 for one contract, but the problem is that it's not gonna let me go through with it. Not enough collateral. You don't have enough buying power to place this order, and basically that's because you have to have $48 multiplied by 100, so $4,800. You have to have that amount of money to go into this because if the price right now is at 48, 41, if it goes lower than 48 or it's on 48, you're buying 100 shares of this company at $48 per share. So it's 4,800 right here. And right now we don't have that money because we already put money into this company before we put it at 47, but we made 100. We didn't make 60. And yeah, so by these like all expire on the 27th, so Friday. All contracts go from like Monday through Friday. Any Friday they expiration pretty much. So like next week's Friday's the 4th, the other week's 11th. Like just every Friday they expire. That's basically how that works. But it's a good idea to do that because the for if it doesn't if it let's say it doesn't go to 48 and it goes above it, you get paid like the $80 and you keep $80 and you don't buy anything. So you're risking this money in a way to buy 100 shares, but it's technically not the worst thing you could do because if you buy 100 shares at 48, right? You're buying 100 at 48, but instead of selling a put, the opposite is selling a call, which therefore means that you're selling. Let me dismiss this. Let me get rid of that order actually. Okay. So what that means is you own shares, let's say at 48. this isn't really realistic because most likely you would be here. If the price went under it, it'll probably be like here, let's say. So you bought at 48. Okay. So the next thing you do is you want to sell the the amount you bought at, like at 48. You would want to sell it, like let's say next week. You would want to sell your shares at 48. You just want to sell it and click on this contract, and you want to sell all your shares. You want to sell all of them, and that would make it so you sell it's 100 shares each is one contract. The price right now it's 240. You could put it at the bid, which is like that, and you could get assigned really quick, or you could make an ask and put it at that, and then you're just asking for like the option at that price, and if someone buys it from you from that price, they're paying you the money, right? So then you want to, instead of selling a put to buy 100, you want to sell a call to sell the same 100 you already bought. And that makes it so next week you'd get paid 243. That's not really the reality because that's a week away. And plus that'll be Friday. The option prices go down over time. That's why like in the beginning of the week you want to buy Monday, and you want to buy Monday, maybe Tuesday, maybe Wednesday. But if you buy like Thursday, you're not making much. If you buy Wednesday, you're not making much. The farther it is, the more you're making. But it's better to put 1 week contracts in. That's what I do. I mean, that's what I recommend because it's just easier. And then next week you could do it again, whatever happens, right? And then this is the other method of selling them. So let's say you would sell them, you make $240. That's not the truth, but you would sell 100 shares for that amount, and you'd make 240. If it goes to 48 above, you're selling your shares plus you already got paid, so you don't care about it going higher. If it stays lower, you still own the shares and you get paid. So either way, you're making money either way. This is like one of the safer ways to invest. I think it's also risky. I've made mistakes with it too. I'll show you that with my actual portfolio. Here we go. This is today. It went down. I was down like 100 at one point. I was up 41, and now I'm like up 17, which is okay, not the worst. But I'll show you my week. My week is kind of I was down, I went up, down, and then I went back up, right? I'll show you my month. This shows that I was down. I was down like 1,000 at that point. Then I was still down a lot of money, down 300, and then I was up. Then I was up like 700, right? 3 months. Well, this is the bad thing that happened to me. So I was here, happy at above 3,000 at $13,000, and I kept losing and losing and losing because I made such a bad trade. I was down almost $3,000 at one point, but then I started climbing back up, and now I'm only down like 800 on the 3 month scale, right? But let's go to the year. Actually, let's go to all time. So I'll share how I started investing. Here's where I started with this is all the money I've put in over all the time I've been investing, and it's pretty like when it starts going up in value or minus. That's when I started buying shares, and my idea was to buy shares for long-term growth, and the shares that pay dividends, which is companies that pay a certain percentage for their share prices every couple months. It's also a good way to invest, but I like this way better, and I will get into dividend investing soon. I have a goal of reaching $15,000 before that. Okay. And then here it was like, oh, it started going down. I started losing money, and I was like, oh, that's bad. But I kept putting more in because I thought eventually it will grow. And I think here's where we had like the COVID crash, like the stock market crash, I think. Around here's when we had the crash, or like this whole thing was going throughout the crash, and then here's like the biggest like way down, and that's annoying. Okay, and then here we go. We start recovering. We start doing our new method. Right here's where I started learning the wheel strategy, which is the one I kind of briefly went over. And then this is where everything starts going uphill for me. I'm doing fine, doing good, up 1,000, up a lot, up even more. Then here I'm up almost 2,000, and there's where I make the bad move, like a really bad move, and I go all the way down to like being down like $2,000. And now I'm recovering, yeah, but it's kind of annoying that I have to recover. But I don't. I take it as a learning experience of not to make the same mistake I've made before. And I'll show you my mistake. So let's go back to DraftKings because this is where I made my mistake. Show history. Oh, here's history. So let's start here. I canceled this order. I put an order. I made 200 for one contract, which is good. Then I put another order. I made 120 for that contract. Good. But then I think at this rate, I got assigned shares. Oh, yeah, I got assigned shares at 59, and I got assigned shares at 57. But what you do if you get assigned shares at 59 and 57, there's a term called cost averaging, which means you buy 59, you buy 57, add both of these, divide it by 2, and that equals 58. So yeah, I made like $320 here in one day, which I was like, oh, that's really good because I made a lot of money. But then the prices kept going down and down and down. So then on October, I sold two contracts, the same contracts from here, and then I owned 100 shares or 200 shares I owned. And over here, I tried to sell my 200 shares. I made 150. Then I did the same thing again, made 150 each contract. Then right here, 100 or 200, 200. I kept selling. But here's where the mistake happened. On November 2nd, the prices started to go up. So that wasn't bad. And that means I sold both my contracts, which was bad. And I lost a lot of money because of this. Then right here, I sold a put. I sold two puts for $340 each, so I made $680. And I was like, that's really good because I'm gonna recover now. And I got that assigned, which was nice. And then I got placed 100 shares again, which I was like, this hopefully doesn't go down again, but I believe in it because they had a really good earnings call. And then over here, I sold it back for 140, so like 70 cents per contract, which is good. So I made all my money back, plus I made this money here. And now I went back in this week again, the 23rd, one yesterday, and it was 105. I made 105 for one contract, which is at 47. Which right now the prices of DraftKings are at 48. So if it goes to 47.5, that means I'm forced to buy 100 shares of this company. But then I could just try to sell it back for the same amount, 47.5, and make whatever they pay me for the contract. Alright? Okay, I'll show you guys what I have a little list. It's not at all in which way professionally made, but I'll explain what it is. So with the method I've showed of options, selling puts and selling calls, this is basically like all of these numbers like 0.07, 0.04, 0.032. This is like when I first started and I didn't want to risk too much. So I was like, oh, 0.7, 0.4, cool, 32. You notice I gradually started increasing the amount I've wanted. I started making 100, 40, 80, 50, 80, 140. Then right here, so I start getting more. That's 300, 260, 300, 102, 200, 200, 600, 100. Wait, why did I have two pluses? 100 and 217. So this is basically I made $38.44, but that's multiplied by 100. That equals 3,844, which is good. That's how much I've made overall, but that's not true because I've also lost some. This is just all the profit I've made without accounting any losses. Okay, and here's another. This is what I've been getting at too. Like this is a DraftKings thing where I said I bought 200 at 40 or 50, 58. I bought 200 shares at this. Then every single week I made 300 one week, $302, and I made 105 or 150. Then I made 100, 200, 300 on it, and it all equaled up to 9.70. But this is every single week because I was originally trying to make my money back selling it, trying to wait for it to go back up to 48 or 58. It never happened. Then here's my overall cost. That's basically this minus this equals this. So this is how much I'm paying for 200 shares because I made this profit. If I made zero profit and I just gained, this is how much I would have made. But that's still not good at all. So the other thing is, I sold the contract at 38. I sold all my shares at $38, which was bad because I lost $1,030. I lost. This is like the bad trade. That's why when you look at my all time, it plummets because that's when I lost all that money at that point, and it wasn't fun. Now I'm in the recovery, but yeah. Now let's look at the recovery process of this section here. This is the same thing. I bought DraftKings again at $44 per share. I think this is 100, maybe 200 shares. I'm not 100% sure. Oh, this is definitely 200 shares. So I'm buying 200 shares, but I made $680 plus 104. But this is because I made 608 beforehand when I was trying to buy them at $44. So that was good. That was a good amount that I've made, and I made that much. And then I sold the same shares at $44 per share. I sold it at $140. So then that reduces my overall cost with this minus this equaling 35 and 8 per share, which is still 3,500. If I end up keeping the shares and never selling them, that'll be my price that I have them until I sell. But then I sold it for the same price at 44. I sold it for the same price I bought it at, so I'm making all this profit because this is all straight profit because I'm selling for the same amount. If I sold it at 38.8 or 35.8, I would make $0 and I would break even, which is not bad, but I'd rather make it than break even or lose. So right here, I made $820 profit, which is good. And that means that now I am almost in the green again. But assuming these contracts here, the DraftKings at 47.5 and 48, if these go positive and these all expire, I'll be in the positive now because I'm down minus 40, 48. So just one of these going good would make me at the break-even mark, which is good because then I'll get all my money back. But then again, I haven't made anything. It's just break-even, so that's not fun, but it's better than losing. Okay, then we go to what we did this week. Because this is all like the past stuff that we've done on previous weeks. This is what we did this week. I sold a contract at Neo for 40. I sold a put on Neo for $48 per share to make $112, which is good. That's a good amount. And then this subtracted by this equals 60 or 46.88, which this is my price if I am to buy 100 shares, which doesn't look like I'm going to buy it, so it looks like I'm going to make $112 profit without buying any shares whatsoever. Also, I did DraftKings this week, and I bought a contract at 47.5 because I thought it was a good idea, and it's still a good idea, and I wanted to make at least $200 this week. And that's like my goal is to make at least $200 every single week. And yeah. So then this minus this is the average cost at 46.45, which is good. It's a good average cost. Both these are good average costs because we'll look at the shares on DraftKings. It's like $1 75 cents over the money. 7, 8. It's almost $1 over the money. Which 75 cents over the money is pretty good because hopefully it's not moving lower, stays around the same. Also, Neo, I bought at 48. It's at 52. We're pretty good at that amount. So our contract should be doing fine. I can show you how these work. So the idea is they don't have okay. So right now this is how much I'm making off of it, the 105, right? Total return today is 40 or 28. That's because that's like the return today, but that doesn't matter. And 40 is like overall how much I made. If I was to sell this contract at this price, I would have to pay them $65 to get rid of the contract, but I would already have made $40. But if I just wait for expiration, then I would be good because I would get paid the full $105, which I'm gonna wait for expiration. Even if I have to buy 100 shares, I'm gonna wait. I'm never gonna sell. Never gonna sell unless the shares go really high up and I want to buy another contract. If this ever reaches 0 or 1 before Friday, think I would probably sell it and try to get into the same company again or a different company before. And this is another thing. This is a put. This is the actual contract. So type limit sell because you always want to put limit sells or limit buys because you don't want to buy at market value or less. And effects is an open contract. This is good for today because I made the trade. That means if it by market close, this would expire. If it doesn't get filled, this is the date I put it in. Submitted in the 23rd. So status filled, so that means I got the contract. Limit price, that's how much I got the contract. Quantity 1. You could put multiple quantities like 2, 3, 4. You just multiply this by the amount, but I'd rather just do one for now. And my filled quantity is 1 contract at that. That's basically how it works. These are like the bids, the asks on the contract right now, which is okay. I like how it's going. But yeah. So far, we're doing fine this week. And hopefully we continue to do fine throughout the rest of the week. And next week we start with all cash again. So yeah, I still have a little bit of buying power left, which I just gonna leave there because I don't know what to buy. But I think I'm gonna end it here. If you guys have any questions, leave some comments below. I also want to talk about shoe reselling and stuff like that, but I don't know if you guys would be interested in that. But maybe because that's also something I do invest in as well. And thanks for watching, guys.